So, India's entire tax landscape is about to go through a pretty massive shift. Today, we're going to unpack the new income tax rules for 2026. And look, these aren't just small tweaks. They're a really clear message from the government about a future that's all about digital tracking and, well, global tax transparency. Let's dig into what this actually means for your company. We've got this broken down into 5 main areas to make it easy. We're going to start with the really big one, the new digital mandate. From there, we'll get into the new rules for global tax and transfer pricing. Then we'll talk about some good news, simpler safe harbor rules. And finally, we'll wrap it all up with a super practical compliance checklist for you. All right, let's just jump right in. First things first, you're going to want to circle this on your calendar. All of these new rules officially kick in on April 1st, 2026, which applies to the 2026-27 tax year. Now, I know that sounds like it's a ways off, but trust me, the clock is ticking to get everything in order. Okay, let's start with what is, honestly, probably the biggest change of them all, the government's major push for a digital-first world when it comes to compliance. And it all starts at the very beginning, how you keep your books and how you handle your audits. So, this whole new digital era, it's really being driven by something called Rule 46. This rule lays out some really strict new requirements for how companies have to maintain their electronic books of account. Basically, if you're not using old-school paper ledgers, this one's for you. And here's the real kicker. It's this dual location requirement. See, it's not enough anymore for your data to just be accessible from India. Your live records have to be accessible in India, and this is the big one. Your daily backups have to be on servers that are physically located within India. For any company that relies on global data centers, this is a huge operational change. This digital push also extends to tax audits. So say goodbye to the days of juggling all those different forms, 3CA, 3CB, 3CD. Now there's just one, single consolidated Form 26. But don't let that simplification fool you, because it actually asks for a lot more information. What's really fascinating here is just the sheer amount of digital detail that Form 26 demands. I mean, we're talking about the nitty-gritty of your accounting software, who your cloud storage provider is, and even the IP addresses and physical locations of your servers. You can totally see how this connects right back to that in-country data rule we just talked about, right? And this focus on digital transparency, well, it doesn't just stop at India's borders. Let's take a look at how this theme of intense scrutiny is now being applied to international deals and all those cross-border tax issues. So if you are a non-resident company and you're doing business in India, this next part is absolutely crucial. Are you claiming benefits under a tax treaty? Because if the answer is yes, you really need to pay close attention to this next change. This slide just perfectly illustrates the new reality. It used to be that you only had to file a Form 10F if your tax residency certificate was missing some information. Well, now, the new Form 41 is mandatory for everyone, every single time, no exceptions. All that old wiggle room, it's just gone. And this new rule, it creates a real practical problem that could easily trip up a lot of non-resident companies. Because even if you don't have a physical office in India, you now have to provide a local communication address to even file Form 41. It's a small detail, but one you really can't afford to miss. Okay, let's switch gears for a second and talk about resident taxpayers who are claiming foreign tax credits. There's a new magic number you've got to remember. 100,000 rupees. This is now a really critical threshold. So what this means is if the foreign tax you've paid is over that 100,000 rupee mark, you now need a chartered accountant to formally verify your claim on the brand new Form 44. The rules also put in a hard 12-month filing deadline, and they get specific, saying the credit is calculated on a net income basis. So, yeah, more hoops to jump through, and you have less time to do it. All right, next up, major changes to transfer pricing. And, that's that famously complicated area that governs how different parts of the same big company price deals with each other. Well, the government is overhauling basically everything from assessments all the way to the fees for pricing agreements. So they're introducing a brand new concept here. It's called the Block Transfer Pricing Assessment. Now, this could be a huge time saver because it lets you do a combined assessment that covers up to 3 years. But, and there's always a but, the catch is that the eligibility criteria are incredibly strict. You need almost perfect consistency across your transactions, your methods, and your filings. And speaking of filings, that transfer pricing report from your accountant, which is now called Form 48, well, it's getting way more detailed. You're going to need to disclose specifics on pretty much everything from stock compensation expenses to your revenue recognition policies, plus all the details of any advance pricing agreements. It's clear the tax authorities want to see everything. The whole way you pay for an advance pricing agreement, or an APA, has also been completely changed. The old system, where the fee was based on how much your transaction was worth, that's out. Now, it's a single, flat fee of 20 lakh rupees. And depending on your business, that could either be a pretty good deal or a significant cost increase. All right, after all those new compliance headaches, here's a little bit of good news, especially if you happen to be in the IT sector. The safe harbor rules, which are basically a government-approved shortcut to give businesses some certainty on their transfer pricing, they're actually being expanded and simplified. I mean, this table really says it all. The old, complicated margin structure, which could have been as high as 24%, is being swapped out for a single, lower margin of 15.5% for a much wider range of IT services. And on top of that, we're also seeing a brand new 15% margin for data center services. This is a very welcome change. So this new, broader category, it lumps together software development, ITES, KPO, and even contract R&D. The main catch for eligibility is that your total revenue can't be more than 2,000 crore rupees. But if you qualify, you can actually lock in this rate for a nice, stable 5-year period. So we have covered a ton of ground. What are the main things you need to take away for your business? Let's try and boil it all down into a final compliance checklist. Okay, here are the 4 big questions your team really needs to be asking right now. Number 1. Are your systems actually ready for the in-country data and backup rule? 2. Are you prepared for the mandatory Form 41 and those tougher foreign tax credit hurdles? 3. How does the new flat fee for APAs change your transfer pricing strategy? And 4. Could you actually benefit from the new lower safe harbor margin? You know, when you take a step back and you look at all of these changes together, one really clear picture starts to emerge. The future of tax in India is digital, it's transparent, and it's built on incredibly strict compliance. So the real question is no longer if this shift is happening, but something much more simple. Is your organization's tax strategy ready for it?